Jobless rate spikes to 26-year high. U.S. employers cut a larger than expected 467,000 jobs in June, and the unemployment rate has climbed to a 26-year high of 9.5%. Actually, it's probably much higher than that. Workers also saw weekly wages fall, suggesting Americans will have little appetite to spend, and the economy's road to recovery will be very bumpy. The new Labor Department report shows that even as the recession gives signs of easing, companies likely will want to keep a lid on costs and be wary of hiring until they feel certain the economy is on solid ground. President Barack Obama, in an interview with the Associated Press, said he is deeply concerned about unemployment and has conceded that too many families are worried about whether they will be next to suffer an economic blow. He also expressed disappointment over the weak employment figures, acknowledging that what we are still seeing is way too many jobs being lost. June's payroll reductions were much deeper than the 363,000 jobs that economists expected. An average weekly earnings dropped to the lowest level in nearly a year. And when they stand up, they're always falling back down, not able to progress. However, economists say the rise in the unemployment rate from 9.4% in May wasn't as sharp as the expected 9.6%. Well, anyway, close enough. Still, many economists predict the jobless rate will hit at least 10% this year and keep rising into next year. Approximately 14.7 million people were unemployed in June. If laid-off workers who have given up looking for new jobs, or those who have settled for part-time work are included, the unemployment rate would have been at least 16.5% in June, the highest on records dating to 1994. We were on the road with things getting less bad, so they say, in the jobs market, and that has been temporarily waylaid, said economist Ken Mayland, president of Clearview Economics. On Wall Street, of course, the employment news pulled stocks even lower. Overseas markets dropped after a report showed unemployment in Europe rose to a 10-year high in May, and since the recession began in December 2007, the economy has lost a net total of 6.5 million jobs. As the downturn, recession, or depression, whatever have you call it, bites into sales and profits, companies have turned to layoffs and other cost-cutting measures to survive. Those include holding down workers' hours and freezing or cutting pay. The average work week in June fell to 33 hours the lowest on records dating back to 1964. We are in some very hard and severe economic times. Labor Secretary Hilda Solis said in an interview, "The President and I are both not happy." Layoffs in May turned out to be smaller, 322,000 versus the 345,000 first reported. But job cuts in April were a bit deeper, 519,000 versus 504,000 according to government data. Nonetheless, and again, how can you have a real economic recovery if, month after month, hundreds and hundreds of thousands of jobs are being lost month after month? It's just not possible. That is the reality of it. Economists say, even with higher pace of job cuts in June, the report indicates that the worst of the layoffs could have passed. The deepest job cuts of the recession came in January, when 741,000 jobs vanished, the most in any month since 1949. For the second quarter, job losses averaged 436,000 a month. That's a lot. Still though, that was down from a monthly average of 691,000 in the first quarter. Economists predict the economy will continue to lose jobs through the rest of this year. And still, job losses last month were widespread. Professional and business services cut 118,000 jobs, more than double the 48,000 cut in May. Manufacturers cut 136,000, down from 156,000. Construction companies got rid of 79,000 jobs, up from 48,000 the previous month. Retailers eliminated 21,000 jobs, up from 17,600. Financial activities cut 27,000 after 30,000 in May. The government cut 52,000 jobs, up from 10,000 the previous month. Leisure and hospitality cut 18,000 jobs, erasing a gain of the same size in May. Average weekly earnings fell from $613.34 in May to $611.49 in June, the lowest level in nearly a year and the first drop since March. And that raises fresh questions about consumers' willingness to spend in the months ahead. And consumers, they drive 2/3 of the U.S. economy. The worst crisis in the housing, credit, and financial markets since the 1930s have plunged the country into the longest recession or depression, or whatever you call it, since World War II. Many think the jobless rate could rise as high as 10.7% by the second quarter of next year. Some even think the rate will top out at 11%. The post-World War II high was 10.8% at the end of 1982, when the country had suffered through a severe recession. Once again, there's something bigger in all this going on here. There's something fundamentally wrong with the economy. There's something actually very wrong with it. there's something more going on here. And once again, all these are more signs of the end times transition days. The transition is ongoing, day by day.